In the past few days, the headlines have been relentless. Blood on the streets, market crashes, whispers of an economic meltdown. Stocks are losing trillions, and crypto markets are plunging. Panic is spreading, but hold up. Is it really time to hit the exit button? Or is this just another twist in the market roller coaster? Today we're diving deep into what's really going on behind the headlines. Is this chaos a sign to run, or just a bump in the road? Stick around as we uncover the truth, analyze the facts, and help you make sense of this wild financial ride. Let's get started. The market panic. First, let's address the immediate concerns. Today, the stock market has lost approximately $1.11 trillion, an enormous figure that can make anyone nervous. Meanwhile, Bitcoin, often viewed as a hedge against traditional markets, has not even declined 10% from its all-time highs. This discrepancy should be a red flag. If the economy were truly collapsing, would Bitcoin remain relatively stable? Probably not. The truth is, markets are highly manipulated and often driven by perceptions rather than reality. Market dips, while unnerving, are part of the natural ebb and flow of financial cycles. Panicking now may lead to poor decisions, especially when understanding the broader economic context is missing. The illusion of economic strength. One of the most significant issues in today's markets is the narrative of a robust economy. Official figures, however, paint a different picture. Recent revelations indicate that the numbers fed to the public are fabricated or heavily revised. For months, experts and analysts have questioned the accuracy of employment data, inflation rates, and GDP figures. President Trump publicly challenged the labor statistics, firing the head of the Bureau of Labor Statistics after job reports were revised downward by over 250,000 jobs. This act underscores a troubling reality. The numbers we're being told are not entirely reliable. Why does this matter? Because economic indicators influence investor confidence and government policy. If these statistics are manipulated or inaccurate, then the supposed recovery or growth is just a facade, a carefully staged theater designed to keep the masses complacent while underlying issues fester. The truth about job reports and inflation. One of the most contentious areas is employment data. The May and June jobs reports saw significant downward revisions, casting doubt on the strength of the job market. The narrative of a booming economy is increasingly being challenged by insiders. Furthermore, the Consumer Price Index, CPI, often used to measure inflation, understates the true rise in the cost of living. Key components like food, fuel, and energy are excluded from official CPI calculations, which means the actual inflation rate could be much higher than reported. This discrepancy hides the real economic pain faced by everyday Americans who are struggling with soaring prices, while official figures suggest stability. Why the government and media might be masking reality. The intentional underreporting of inflation and employment struggles isn't accidental, it's strategic. Governments and central banks prefer to keep the narrative of economic resilience alive, at least on the surface. So markets remain buoyant and political stability is maintained. But beneath the surface, the cracks are widening. As inflation accelerates and real wages stagnate or decline, the purchasing power of the average citizen diminishes. This disparity fuels social unrest and economic uncertainty, factors that can trigger market volatility. The role of the Federal Reserve and tariffs. Another critical aspect fueling economic distortions is monetary policy, especially the Federal Reserve's aggressive money printing. Central banks worldwide are engaging in unprecedented levels of quantitative easing, flooding markets with liquidity. While this may temporarily prop up asset prices, it risks creating a bubble that could burst catastrophically. Similarly, recent tariffs aimed at revitalizing manufacturing in the US have had unintended consequences. Instead of rejuvenating domestic industry, tariffs tend to increase costs for consumers and businesses, leading to higher inflation. According to economic experts like Mark Zandandi, inflation is not only persistent, but accelerating, driven by these trade policies and ongoing monetary expansion. The globalist perspective and nuclear threats. Adding to the chaos are geopolitical tensions. Statements from leaders about the possibility of nuclear conflict with Russia have raised alarm bells. However, many analysts believe such threats are more bluster than reality. The globalists, powerful elites with vested interests, prefer chaos to justify increased control and further economic interventions rather than risking the destruction that nuclear war would bring. In reality, nuclear war would be catastrophic globally, and both superpowers have little incentive to unleash such destruction. These threats serve to manipulate public sentiment, fostering fear and compliance. The reality of market manipulation and misinformation. Given the manipulation of economic data and geopolitical posturing, it's clear that markets are far from transparent. The narrative of a strong economy is largely a facade designed to keep the masses invested and complacent. When the truth finally surfaces, be it through revised reports, inflation surges, or geopolitical crises, the fallout could be severe. Why Bitcoin remains a hedge? Amidst this chaos, Bitcoin stands out as a beacon of hope for many investors. Why? Because Bitcoin is inherently designed to hedge against inflation and currency devaluation. Unlike fiat currencies printed endlessly by central banks, Bitcoin has a fixed supply cap of 21 million coins. During periods of monetary expansion, Bitcoin's value tends to rise as people seek a store of value outside of government-controlled fiat. Historical data supports this. In times of currency devaluation and inflation, Bitcoin often outperforms traditional assets. Furthermore, as the economy becomes more unstable, the demand for decentralized assets like Bitcoin increases. This is why many investors see Bitcoin not just as a speculative asset, but as a long-term hedge against systemic failures. The future outlook: prepare for a long-term bull run. While the current panic is palpable, it's essential to maintain perspective. Market crashes and corrections are part of the natural cycle, and savvy investors understand that downturns often present buying opportunities. Experts predict that a significant bear market is on the horizon, possibly the biggest in recent history. But with every bear market comes a chance to accumulate more Bitcoin at lower prices, setting the stage for a substantial rally when conditions stabilize. Strategic advice: hold on to your Bitcoin for the long term. Consider taking profits during bullish phases to fund future investments. Use dips as opportunities to accumulate more Bitcoin, preparing for the inevitable rebound. Stay calm, stay informed. In times of chaos, misinformation and fear can cloud judgment. But knowledge is power. Recognize that current market turmoil is driven by a combination of manipulated data, geopolitical tactics, and economic policies designed to keep the status quo. Understand that Bitcoin's fundamentals remain strong, especially as inflation accelerates and fiat currencies weaken. If you're worried about your investments, remember, patience and prudence are your best allies. Stay informed, diversify your assets, and consider the long-term potential of Bitcoin as a safeguard against systemic collapse. In conclusion, there's no need to panic and exit Bitcoin hastily. Instead, view current events as an opportunity, an inflection point that might lead to significant gains in the future. Stay calm, stay strategic, and keep your eyes on the long-term horizon.